So a $1.3 billion real estate Ponzi scheme was just broken up in Beverly Hills. This is only 6 months ago, or maybe 9 months ago. So what a Ponzi scheme is pretty simple. You simply just borrow money from one investor, promise them a great return, and then use the other investor's money to pay back the first investor. And then you just keep repeating the process over and over and over again. And then ultimately you end up accumulating a big chunk of cash, and you've done nothing except really done wrong by all these investors. So that's what happened. 8,400 people invested money expecting a tremendous return, roughly 10%, which is huge. Normally a good return might be 5%, 6%, maybe 6.5%. Hard money lenders are charging 10% and 12%. So they were issuing these types of returns, and how they were able to do it is that they were advertising in newspapers, magazines, radio, TV, all across America, primarily heavy saturation in Florida, because that's where retirees are. And they're the perfect victim because they're older, they have money, and they want more money because they want to live a better life. They want to travel more, maybe feel like they should give more to the church, to their family, friends, to really do more and be more because they have nothing else to do. So they want a better return on the amount of money that they have sitting in maybe a checking account, or maybe sitting in the markets, or sitting in a 401k, wherever it is. So they end up investing their money with this company, and this company then says, I'm going to invest in all these high-end properties all over the country, and then you're going to get huge checks because I'm going to lease these properties out. I'm going to pay off my investors in the form of these lease checks, and your principal investment is protected against the deed of the property. So you're going to then be co-owner in all these properties. So then the investors thought, wow, I'm investing. Now, not only am I investing, I'm investing in real estate, high-end real estate, and I'm getting returns. And if anything happens, I could just sell the property. I could sell the property with the investors, and we'll get all of our money back. So people see this as there's a no-lose situation. And so when there's a no-lose situation, you're not going to only put in 10% or 20%. You're going to put in the whole 100. Why not put in 100%? If you're not going to lose it, where's the risk? And that's what happened. All these retirees lost money. But not just retirees, other people as well, working class people. People put in whatever they could afford to put in. And then what the founder did, his name was Robert Shapiro. What Robert Shapiro then did was commissioned all these high tactic sales strategies, commissioning these salesmen, and I'm sure saleswomen, to close these deals. So they were giving them maybe 10% or more in commissions on the money they could extract from these people. So imagine, get on a phone call with someone, they want to invest $100K, and you're going to make $10,000 or $15,000 to close that sale. So these people were extremely motivated to close the sale, and they were making a ton of money doing it. So in a short period of time, they raised $1.3 billion in cash, bought all these properties, and then what happened? They couldn't keep up. They couldn't keep up with the payments because they weren't actually making money. They weren't making money buying these high-end properties and leasing them out. Some of the properties didn't even exist that investors thought that they owned. And so Woodbridge was the primary company, and they had roughly 270 companies below Woodbridge, and they would let all the money kind of go out throughout all these other companies to hide the funds. And then the founder was out on private jets buying, multi-carat rings, like 30-carat diamond rings, Picasso paintings, all of these luxuries. Probably spent 25 or 30 million in luxuries. Did like a $1.8 million renovation to his house, and doing all these things, living high off the hog, where all these investors think that they're set up because they're going to have that 10% come in next month, and they're protected against this property, and they have nothing to worry about. And what's happening now is that they're probably overspending because they think that they're so set up they have nothing to worry about. And then eventually, couldn't keep up, and they got busted. SEC, the Security and Exchange Commission, was watching them for a while. They zoned in, broke it up once they couldn't pay investors, and that was it. Now what's happening is, which to me is even more fascinating than all of that. That's very unfortunate. But what's fascinating is how the government is stepping in and what their vision of a solution is. The SEC is charging a $120 million fine. A $120 million fine to Woodbridge. The only issue with that is that Woodbridge is no longer a company, and the CEO and founder, Robert Shapiro, was just sentenced to prison for 25 years. So they issued this $120 million fine. Who's going to pay it? They have $1.3 billion in overall cash invested, but they were buying in 2015 and onwards when the market was iron hot. So they were buying all these properties, and they've been liquidating properties consistently, pretty recently. But they've been liquidating properties. They're not going to liquidate more than $1.3 billion. They're liquidating a lot less than that. They didn't care about the price. They were just buying everything. So they're taking substantial losses on a lot of these properties, and then they're going to issue a $120 million fine to the gross proceeds. So then who's really paying? It's the investors. So the investors not only lost money investing with Robert Shapiro and Woodbridge, but now the SEC is coming in and taking money right out of their own pockets. So now you have the Securities and Exchange Commission coming in and taking money. And what's the lesson to be learned here? And because with big things like this, there's always a great lesson. And I think the greatest lesson to learn here is what not to do. And what not to do is don't invest with other people if you don't understand what the business model is. You don't understand what's happening. And that's what happened here. They didn't understand. They just got greedy. They let greed kick in, and they thought, I deserve 10%. I deserve this. And they didn't deserve it because it wasn't a real, actual business. And they ended up losing. Greed kills all. They say that greed comes before a fall. And that's ultimately what happened. The other lesson is understand what you're investing in. If you don't know what you're investing in, you're not investing. You're speculating. You're gambling. And most gamblers lose money. For example, if you're interested in stocks, who the CEO of the company is, what is their competitive advantage? Are their competitors gaining market share or losing market share? Do they have a real viable business that can expand and become much bigger in the coming few years? What are the biggest downfalls? How much has the stock picked up or decreased in the last couple of years? Where do you see the stock going and why? Once you really, really, really dive in and you can understand the company, looking at their balance sheet, looking at the profit and loss statement, seeing who that company really is, then you can say, okay, I'm going to go invest in that company because that's what you're doing. You're now investing. But if you're not doing that type of research and spending all these hours researching what you're putting your money in, you're not investing. You're speculating. So that definitely applies here with this fund, with this real estate fund, Woodbridge Companies. So that being said, understand what you're doing. If for real estate, for example, if you want to become a real estate investor and you know nothing about real estate, first thing you should ask yourself is, what types of properties do I want to invest in and why? And then try to prove yourself wrong. Like Elon Musk, he says, when I come up with an idea, I don't try to prove my idea right. I try to prove my idea wrong. And so that's what I would recommend you to do as a real estate investor. Think of why you want to do this specific type of investment, then try to prove it wrong. Factor in every other type of deal that you could possibly buy. Consider your location. Consider that location against other locations. Think about price point. Think about what you can afford to buy. Think about market saturation. Think about everything that there is to think about. And the more you know, the less you're going to lose. And that's just business as a whole. So don't let greed get ahead of you. I mean, this is like the Bernie Madoff scheme on a much smaller level. I think Madoff made 50 billion or more, or he raised 50 billion or more from high net worth individuals in Wall Street. And this person is $1.3 billion, but he grew that pretty fast. all by promising people these unattainable, unrealistic returns. But that's a testament to what people look for. They look for unrealistic returns. They look for these grandiose, get-rich-quick ideas that don't exist. Like, I'm going to take my comment on drop shipping, on Forex, on all these things. It's like, it could work, but I think that the person selling the course it's working a lot better for them. Because drop shipping, Forex, I don't think that's going to be here. I don't think that's going to be the main thing of drop shipping specifically. I don't think drop shipping will be here in a couple of years. I think right now it's a little trend and it's going to fade. And we all see these trends happen. But if you look at where the real wealth is made, it's made being a specialist in a specific area. So don't give all your money to someone to invest without you really understanding where that money is going, understanding the contract, understanding the terms, and having that right plan and having an escape strategy. If you want to get out, can you get out? Can you get your money back? Because most of these in the fine print, it will say that it's not up to you. It's up to the partner. It's up to the other person. So once you sign that dotted line, that money is gone, and you're at the mercy of this person. So what I always suggest to do is start reading these books. Start reading books in general and just zoning in and getting that education. Invest your money and learn before you go ahead and give your money to someone else. And if you are going to partner up with someone, not saying it's a bad idea. I think partnerships are great, but just understand the types of properties you're going to invest in and make sure you're associated with that deal, and make sure that it's legitimate. Make sure it's real. And I'm sure if you do all your homework that the right outcome will follow. So please like, comment, and subscribe. Thank you so much for watching.